Welcome to Breaking News to Trading Moves.
Glad to be here.
We're going to look at a specific headline and then move directly to the market winners and losers. We aren't here to just read the news.
No, not at all.
We are here to figure out what it means for the tickers in your portfolio.
It's all about moving from the information to the implication. You see the headline, but the real work is trying to understand where the capital flows might go as a result.
So let's get right into it. The focal point today is Stellantis. For those of you tracking the charts, the ticker is STLA.
STLA.
The news broke, and, well, it was not the kind of update shareholders were hoping for. Stellantis shares dropped sharply.
They really did.
And the catalyst wasn't just a missed earnings number or something simple like that. It was something larger.
It was a structural adjustment, a massive one, really.
We are talking about the company flagging a write-down of $26.5 billion. That's billion with a B, all related to electric vehicles or EVs.
That is a staggering figure. $26.5 billion.
It's a number that just makes you stop and really take notice.
It is. A write-down of that size essentially means the company is acknowledging that the value of certain assets, in this case, related to their EV investments and future projections, is just not what they previously thought.
So they're admitting they got it wrong.
It's an admission that the path they were on is worth less than it was on the books.
Yeah.
A very public one.
And it didn't stop there. This write-down, it's explicitly tied to them scaling back their electric vehicle ambitions. It's a pivot.
A major pivot.
And along with that strategic change came a pretty tough financial outlook. Stellantis indicated a large loss for the second half of 2025. And maybe most painful for the income-focused investors out there, the company stated they will not pay a dividend this year.
And that dividend pause, that's the exclamation point on the sentence. It signals cash conservation.
Right. We need to hold on to our money.
Exactly. When a major automaker stops paying a dividend, it tells the market that preserving capital is now much more critical than rewarding shareholders in the immediate term. It just changes the investment thesis for a lot of people holding that stock.
So, to sum it up, a massive write-down, a strategy shift away from aggressive EV scaling, a projected loss, and a cut dividend. That is the headline for STLA.
A pretty brutal headline.
But, as we always say, the story doesn't end with the company in the headline.
No, it really does.
So let's move to our first section. Why do markets care? I mean, beyond just the shareholders of Stellantis, why is this grabbing so much attention?
Well, because this isn't just a Stellantis story. If this were, say, an isolated operational failure, the market might just shrug it off as one company having a bad year.
Okay.
But this feels like it's indicative of a broader trend. The core issue here is a reset in expectations regarding EV spending and profitability across the whole industry.
A reset. That is a powerful word.
It is, because for years, the industry operated under the assumption of a very steep, a very fast adoption curve for electric vehicles.
The hockey stick graph that everyone showed.
The hockey stick graph.
Okay.
Exactly.
Yeah.
Automakers poured billions and billions into that assumption. What Stellantis is doing, by taking this huge hit, suggests that curve is flattening. And that changes the math for everyone.
And when you say everyone, we are talking about affected sectors across the board.
Correct. It extends across the entire auto ecosystem.
Yeah.
I mean, we have to look at how this reset affects the broader auto sector, of course. That's the obvious part.
Sure.
But it also impacts the suppliers, the battery materials companies, the guys building the charging infrastructure.
And the consumer, right, their behavior has to change too.
Absolutely. It impacts consumer behavior. Specifically, that choice between buying a new car versus a used car, and maybe even more importantly, how long consumers decide to keep their current vehicles.
If the shiny new thing isn't coming as fast.
Or if the automakers are pulling back on pushing them, yeah, consumers might just hold on to what they have.
Which brings us to the part of the show where we really get specific. We've established the context. Now let's talk about the beneficiaries, the winners.
Right.
If Stellantis and potentially others are stepping back from this aggressive EV push, who steps up? Or, who benefits from the status quo remaining in place longer than expected?
We have three main categories of winners here. And the first one is, I think, the most intuitive. It's the auto aftermarket and repair retailers.
The logic here seems pretty straightforward, but walk us through it.
It comes down to the average age of the fleet. Cars on the road. If automakers pull back on aggressive EV rollouts, or if consumers just feel uncertain about the whole transition.
Which they might after seeing a headline like this.
Of course. They're likely to keep their current vehicles longer.
And older vehicles. need more love.
They do. They need more maintenance. They need replacement parts. A 3-year-old car might need an oil change and some new tires. A 10-year-old car, though, it needs an alternator, a starter, a timing belt, new brakes.
All the expensive stuff.
All the expensive higher margin stuff. So the older the fleet gets, the more money flows into that repair ecosystem. The demand becomes incredibly resilient because fixing your current car is almost always cheaper than buying a new one.
So who are the players here? Let's get into the tickers.
First up, you have O'Reilly Automotive. The ticker there is ORLY.
ORLY.
They're just a massive player in the aftermarket space. They serve both the professional mechanics, the do-it-for-me crowd, and the DIY folks.
Okay, got it. Who else?
Then you have AutoZone. The ticker is AZO, a very similar business model, an extremely strong presence in that retail market. When people decide to fix their car in the driveway on a Saturday to save money, they often end up at an AutoZone.
And the third one in that group?
Advance Auto Parts, ticker AAP. They operate in the exact same ecosystem. So if the thesis is that cars are simply going to stay on the road longer, all three of these companies stand to see sustained, resilient demand. It's a volume game for them.
More miles driven on older cars just equals more parts sold.
That's right.
It makes perfect sense. If I'm not buying that new EV because the rollout is slowing down or I'm worried about it, I'm probably putting new tires and brake pads on my current sedan.
Precisely. You're keeping it running. And that's money in the bank for ORLY, AZO, and AAP.
Okay, let's look at the second category of winners. This one is adjacent to repairs. We're talking about used car retailers and marketplaces.
Right, and this ties back to that consumer uncertainty we mentioned. When there is uncertainty surrounding EVs, you've got range anxiety, price concerns, charging questions, and now shifting strategies from the manufacturers themselves.
It's a lot for a buyer to process.
It is, and consumers tend to retreat to what they know. They stick to the familiar.
And the familiar is the internal combustion engine, or ICE.
Exactly. But new car prices have been stubbornly high for a while now. So these shifting model strategies can keep buyers focused on used vehicles. You look for value pricing.
So the volume of sales in the used market stays high, or maybe even grows.
Yes.
Yeah.
And there's another really important component here that we have to talk about. It's called the financing attach.
Explain that for us. What does that mean?
It refers to the loans that are attached to the sales. Companies like CarMax and Carvana, they don't just sell you the car. That's only part of their business. They often arrange the financing for that car.
The loan.
The loan. And that's a very profitable business. So if sales volumes remain robust because people are avoiding the new EV market, that financing revenue stream remains healthy as well.
I see. So the tickers to watch here?
CarMax is the big one. The ticker is KMX. They are the heavyweight, the big box retailer in the used car space.
KMX.
And then you have Carvana, ticker CVNA. Now, despite their volatility in the past, they are a pure play on the digital used car marketplace. So if the consumer shifts their attention away from the new EV showroom and back to the used the used car app on their phone, these are the platforms that are positioned to capture that traffic.
It really highlights how a slowdown in one area new EV production can feed volume directly into another. It's almost like a seesaw.
That is a great way to visualize it. One side goes down, the other goes up.
Okay, let's move to the third and final category of winners. This one might seem a bit counterintuitive if you were convinced the world was going electric overnight. We're talking about refiners and fuel supply beneficiaries.
Right, and this is all about a concept that the market calls the IC tail.
The IC tail, explain that.
So IC stands for internal combustion engine. The tail just refers to the lifespan and the lingering presence of these gasoline-powered vehicles on the road.
How long they stick around.
How long they stick around. If the EV adoption curve slows at the margin, meaning if we don't hit those very aggressive government and manufacturer targets for 2030 or 2035, then the IC tail extends, it gets longer.
Meaning gas-powered cars are on the road being used for longer than the forecasts previously assumed.
Exactly. And cars on the road need fuel. This supports the expectations for fuel demand compared to previous forecasts that assumed a faster EV adoption would, kill gasoline demand much more quickly.
So the demand destruction is delayed.
It's delayed. And if that's the case, the refiners have a longer runway of profitability than people were pricing in.
So who benefits from us all filling up at the pump for a few more years than expected?
Marathon Petroleum is a key name here. The ticker is MPC. They are a major domestic refiner.
MPC.
And Valero Energy. The ticker is VLO, another giant in the space. These companies are in the business of turning crude oil into the gasoline and diesel that powers the legacy fleet. If that legacy fleet stays dominant for longer, their business model remains very robust.
So to recap the winners, we've got the folks who fix the old cars.
ORLYAZOAAV.
Folks who sell the used cars.
JMXCVNA.
And the folks who fuel the old cars.
MPC and VLO. All benefiting from a pause or a slowdown in this EV transition.
That is the winner's side of the ledger. It's the trade on longevity and legacy, really.
That's a good way to put it.
But where there are winners, there are inevitably losers. Section 3 covers the entities that are hurt by this news and the trend it represents.
And there are a few clear groups here.
Let's start with the most obvious one. The legacy automakers with EV transition execution risk.
This is where the Stellantis news really hits home. The large write-down and the dividend pause we discussed right at the top, these just raise serious investor concerns.
It makes investors look at all the other big automakers and ask, are you next?
Precisely. The concerns center on ROI, return on investment, for these massive EV projects. These companies are spending tens of billions of dollars to retool factories, to design new platforms. If the sales aren't there to support it, the ROI just crashes.
And then there are questions about capital expenditure or CapEx discipline.
Right. Are they throwing good money after bad? Is this a disciplined investment, or are they just chasing a trend? And finally, it calls into question the accuracy of their demand forecasting. If Stellantis got it this wrong.
Investors have to worry that the other traditional original equipment manufacturers, the OEMs, might have also miscalculated.
It casts a shadow over the whole group.
So obviously Stellantis is in this group, ticker STLA. But who else is in the splash zone here?
You have to look at General Motors, ticker GAGM. They have made enormous commitments to electrification, their whole Everybody In campaign. If the market resets, they face very similar execution risks.
And Ford.
Ford as well, ticker F. They famously split their business into the EV side and the ICE side, but they face the same headwinds.
Yeah.
If the consumer isn't buying at the rate that was projected, those shiny new factories and battery plants become very heavy financial burdens.
It creates a really difficult environment for these legacy giants. They know they have to pivot, but the ground is moving underneath them as they do it.
It is an incredibly precarious position to be in.
Let's look at the second category of losers. This one is purely about infrastructure. We're talking about EV charging.
This is a classic utilization problem. The entire business model for these charging companies, it relies on volume. They need cars plugging in consistently.
Just like a gas station needs cars at the pump.
Exactly. But with a gas station, the demand is established. It's been there for 100 years. With EV charging, the business plans were all built on a very aggressive growth curve. Any perceived postponement or slowdown in the mass market rollout of EVs, it just hits those utilization assumptions hard.
So if there are fewer EVs on the road than planned for this year, the chargers just sit idle more often.
And idle chargers don't generate revenue, but they still have costs. It also impacts their plans for network expansion. I mean, if you aren't making money on the current units you have, it's very hard to justify building more.
And it must affect their funding conditions.
Absolutely. Investors are much less likely to give you capital to expand if the demand isn't materializing the way you promised it would.
So the ticker's taking the heat here.
ChargePoint is a major one. Ticker CHPT. They're a leader in the space, but their stock price is extremely sensitive to these adoption rates.
CHPT.
And EVgo. Ticker EVGO. It's the same story. They need mass adoption to drive the utilization rates that make their model work. A reset in EV expectations from a major player like Stellantis is a direct headwind for them.
Okay, the final category of losers. We're going further upstream now, back to the source of it all.
Right, to the materials. Battery materials and EV supply chain sensitivity.
This sounds like basic supply and demand.
It is. It's economics 101. The miners and the chemical companies, they ramped up production based on the automakers' public targets. They opened mines, they built processing plants, they expanded capacity because the OEMs said, we will need this much lithium.
But now the OEMs are saying, actually, hold on, we might not need that much quite yet.
Correct. So if OEMs moderate their EV production targets, the demand expectations for lithium and related materials get revised downward immediately.
And when demand expectations drop,
prices drop. And the market sentiment for these stocks takes a big hit. It was a boom, and now it's looking like a bust.
So who are the names to watch here?
Albemarle, ticker ALB. They are a global leader in lithium. Their fortunes are very closely tied to EV battery demand.
ALB.
And Livent, ticker LTHM, another pure-play lithium producer. If the automakers tap the brakes, these are the companies that feel that deceleration first, rather than their order books.
So to summarize the losers, we have the legacy OEMs facing execution risk,
STLA, GMF,
the charging networks facing low utilization,
CHPT, EVGO,
and the material suppliers facing lower demand.
ALB, LTHM. It is a really comprehensive list of sectors feeling the pressure from this one announcement.
It just shows you how interconnected this entire industry is. A decision in one boardroom sends out these waves.
It absolutely does.
We have covered the news, the winners and the losers, but the story is still developing. We need to know what to look for in the coming weeks and months. So, Section 4, what to watch next.
There are 3 specific indicators I'm watching very closely.
Let's start with Stellantis itself.
We need to listen very, very closely to the Stellantis management call. The press release gave us the bad news, but the call will give us the details, the color.
What specifically are you listening for?
I'm looking for commentary on specific changes to their EV strategy. Not just we're scaling back, but how. What models are being delayed? What platforms are being cut?
And the money.
Yes. Priorities for capital expenditure. Where are they cutting spending? And maybe most importantly, the timeline for stabilization. When do they expect to stop the bleeding and get back on track? That clarity is going to be crucial for the stock to find a floor.
What about the rest of the industry? The competitors?
We need to watch for competitor updates. We're in or approaching earnings season for many of these companies, so we need to watch for any updates from the other automakers regarding their 2026 EV targets.
Do they hold the line, or do they follow Stellantis and lower expectations?
Exactly. Will they try to maintain their targets, or will they use the Stellantis news as cover to lower their own bars? Also, you have to watch incentive structures. Are they putting huge discounts on the hood to move EVs?
And inventory levels?
And inventory levels. If inventory is piling up on dealer lots, that is a major warning sign.
And the third thing to watch?
Supply chain guidance. This is the canary in the coal mine. You have to look for read-throughs to battery and charging guidance in their upcoming earnings reports.
Explain read-throughs for us.
It means listening to what a supplier says to understand what your customer is doing.
Yeah.
For instance, if a battery maker comes out and says, our orders for Q3 are down 20%, that tells you the automakers are slowing production, even if the automakers hasn't publicly announced it yet.
It lets you see the move before it becomes the headline.
That's it, exactly. You're following the orders, not the press releases.
This has been a very comprehensive look at the situation. We've covered a lot of ground today, from a $26 billion write-down all the way to the specific tickers in repair, refining, and mining.
It's a complex situation for sure, but the market reaction creates these clear lanes of opportunity and risk.
I want to circle back to that first group of winners we discussed, the auto aftermarket retailers. We mentioned O'Reilly, AutoZone, and Advance Auto Parts. The logic that old cars break is simple enough, but there has to be more to the investment thesis than just, rusted bolts. Why are these companies such darlings of Wall Street so often?
You're right to push on that. It's not just that the cars break. It's the market structure these companies have built over decades. If you take O'Reilly, that's ORLY, and AutoZone, AZO, they have essentially built a logistics duopoly.
A duopoly? How so?
Okay, think about what happens when your car breaks down. You take it to a mechanic. That mechanic has a lift, and now your car is stuck on it. Every single hour that car sits there waiting for a part, that mechanic is losing money because they can't put another paying customer's car on the lift.
So speed is the currency.
The speed is everything.
Yeah.
And O'Reilly and AutoZone have mastered the supply chain to a degree that is almost military-like in its precision. They can get a very specific alternator for a 2014 Ford Fusion to a shop in 20 minutes or less in most major metro areas.
And the little guy can't compete?
The smaller independent parts stores simply cannot compete with that depth of inventory and that speed of delivery. They just can't.
So in an environment where people are keeping cars longer, the volume of repairs goes up. But because these cars are older, the repairs are more critical. You aren't just buying, air fresheners. You're buying control arms and fuel pumps.
Correct. We call those hard parts. And hard parts carry significant margins. But here's the real kicker, especially regarding the current economic climate. If we're in a period where the consumer is stretched, maybe inflation is high, interest rates are up, they can't afford a new car payment. A $500 repair bill is painful, no doubt, but a $700 monthly car payment for 7 years is impossible.
It's the lesser of two evils for the consumer's wallet.
It becomes non-discretionary spending. You have to get to work, you have to pick up the kids, you have to fix the car. This gives companies like O'Reilly incredible pricing power. They can raise prices on parts to offset their own costs, and the consumer, well, they have to pay it.
Which is why they're seen as defensive plays during economic uncertainty.
Exactly.
And what about Advance Auto Parts, ticker AAP? You mentioned them, but they often seem to lag behind the other two in stock performance. Why is that?
Advance has struggled with integration issues and operational efficiency compared to, the green and orange machines of O'Reilly and AutoZone. They've been in a perpetual turnaround for a while. However, in a rising tide scenario, where the entire aftermarket sector gets a boost from an aging fleet, even the laggard can perform well. It becomes a value play.
A catch-up trade.
Right. An investor might look at the valuation gap between ORLY and AAP and think, if Advance can just get their operations half as good as O'Reilly, the stock has a lot of room to run.
So it's a turnaround story versus a compounding quality story.
That is the trade-off. But broadly, the whole sector wins when new car sales stall.
Let's pivot deeper into the used car ecosystem. We talked about CarMax, KMX, and Carvana, CVNA. I think people often misunderstand how these companies actually make their money. It's not just buying low and selling high on the vehicle itself, is it?
No, not at all. The metal is often just a conduit. The real profit engine, especially for a mature company like CarMax, is the finance arm. CarMax Auto Finance, or CAF.
How does that work in this specific Stellantis context?
Well, if the new car market is frozen or just confusing because of this whole EV pivot situation, customers flock to used cars. That drives volume for CarMax. But used cars have become very expensive. The average transaction price is high.
Most Americans can't write a check for $25,000.
Exactly. They need a loan. They have to borrow. And because used car loans are considered slightly higher risk than new car loans, the interest rates are typically higher. The spread, or the margin on that financing, is a massive contributor to the bottom line. When CarMax sells a car, they are also selling a very profitable financial product.
And Carvana, they had a near-death experience not too long ago regarding their debt.
They absolutely did.
Yeah.
But they've restructured and focused intensely on unit economics, making sure they actually make a profit on every single car sold, rather than just chasing growth at all costs. The Stellantis news helps them because it validates the used car as a primary consumer option right now.
So it gives them breathing room.
It does. And Carvana's model is vertically integrated. They own their own auction capability, their own logistics, the vending machines. If they can control costs, a stable to strong used car market is exactly what they need.
If the ICE tail extends, as we discussed, that means the supply of used gas-powered cars will eventually remain robust. But in the short term, isn't there a supply crunch? If fewer new cars were made during the pandemic.
You're pointing out the donut hole in the supply chain that we are currently navigating. You are absolutely right. The lack of production in 2020 and 2021 means there are fewer 3 to 4-year-old off-lease cars coming back today.
Which should hurt them.
Well, this scarcity actually keeps used car prices elevated, which is a double-edged sword. It protects the margins for KMX and CVNA, assuming they can get their hands on enough inventory. It's a balancing act.
They need cars to sell, but the high prices help profit.
Right. But looking at the Stellantis write-down, what it suggests is that the flood of cheap new EVs that was supposed to come and crush used car values, well, that flood isn't coming anytime soon, and that removes a major risk that was hanging over the used car retailers.
Let's move to the energy sector. The refiners. Marathon Petroleum, MPC, and Valero VLO. You called this the ICE tail trade. I want to challenge this a bit. Even if the transition is slower, it's still happening, right? So why would an investor buy into a refiner now?
It comes down to cash flow yield. You have to look at how these companies are behaving. Are they building new refineries?
No, I don't think a new major refinery has been built in the U.S. in decades.
Exactly. Regulatory pressure and the long-term energy transition mean that supply is capped. No one is spending billions of dollars to build a new gasoline plant. So you have a fixed or even shrinking supply base.
And thanks to this delay in the EV transition, demand is holding up better than expected.
Supply is tight. Demand is steady. That creates very healthy crack spreads, which is the industry term for the difference between the price of crude oil and the price of the refined products like gasoline and diesel.
So they are just milking the cash cow.
They are maximizing the value of their existing assets. And since they aren't spending billions on huge growth projects on CapEx, they have a ton of excess cash. So what do they do with it?
Return it to shareholders.
They buy back shares, and they pay handsome dividends.
So while Stellantis is cutting its dividend to fund a difficult transition, Valero and Marathon might be raising theirs because that same transition is delayed.
That is the divergence right there. One company is capital hungry, the other is capital rich. For an income-focused investor, the refiner looks a lot more attractive in this specific window of time than the automaker trying to reinvent itself from the ground up.
Now let's go back to the losers. We need to really unpack the pain for the automakers. Stellantis, STLA, GM, and Ford, F. The outline mentioned an execution risk. What does that actually look like on the factory floor?
It looks like massive inefficiency. These companies are trying to run two completely separate businesses at the same time. They have their legacy ICE business, which is profitable and makes the money, and they have the new EV business, which just burns money.
And they're trying to scale one while managing the decline of the other. It sounds incredibly difficult.
It is. You have duplicated costs everywhere. You have R&D teams for engines and transmissions and separate R&D teams for batteries and electric motors. You have factories that are half converted, running two different kinds of assembly lines. When Stellantis writes down $26.5 billion, they're saying, we spent money on tools, dies, and platforms that we now aren't going to use as much as we thought.
It's money just set on fire.
Essentially. And the risk for GM and Ford is that they are caught in the exact same trap. If they built a battery plant, assuming they would sell 1 million EVs in 2026, and they only sell 400,000, that plant is a financial albatross around their neck.
Because it has fixed costs.
It has huge fixed cost, heating, lighting, security, staff that have to be paid regardless of how many batteries come out the door. Underutilization kills margins in manufacturing.
It destroys them.
It absolutely destroys them. And that is why the market is punishing these stocks. The operating leverage that helps them on the way up is now working viciously against them on the way down.
Okay, then there is the charging infrastructure. ChargePoint, CHPT, and EVgo, EVGO. I feel like I've seen these stocks sliding for a long time. Is this news the final nail in the coffin, or is it just more of the same bad news?
It's a compounding of the core problem. Their business model is a mix of hardware plus software plus service.
Yeah.
But mostly, they need the network effect. They need density. If I'm an investor looking at these companies, I'm asking one question. When does this company become profitable?
And every time an automaker pushes back their EV target, that profitability date gets pushed back too.
Exactly. It just shifts further out into the future. If Ford says, we're delaying our big EV truck rollout by a year, ChargePoint's revenue model effectively shifts to the right by a year. But their cash burn doesn't stop. They still have to pay salaries and rent today.
So they might run out of runway.
That is the risk. We call it liquidity risk. Can they survive long enough to actually see the mass adoption they've been waiting for? The Stellantis news suggests the wait just got longer. And that increases the risk of dilution, meaning they have to sell more stock to raise cash, hurting existing shareholders, or even bankruptcy for the weaker players in the space.
Finally, the lithium plays. Albemarle, ALB, and Livent, LTHM. This seems like a classic commodity boom and bust cycle playing out.
It's a perfect example of the Bullitt effect. When EV demand was hot and projections were through the roof, everyone rushed to open lithium mines. Prices went parabolic. Now all that new supply is coming online, just as demand is cooling off.
So you have a glut.
A massive glut. And unlike a factory, you can just idle for a few months. A mine is hard to stop and start. You've already taken this stuff out of the ground. You have to sell it for something. This pushes prices down to the marginal cost of production, or even below.
So for ALB and LTHM, their earnings are going to get crushed until that supply surplus is worked off.
And that takes time. Years, potentially. The Stellantis pivot just confirms that the demand side of the equation is weaker than all the models predicted a year or two ago.
It is really fascinating to see how a decision in a boardroom in Europe regarding Stellantis can send shockwaves through a lithium mine in Australia or South America.
Capital markets are the nervous system of the global economy. One signal, one twitch, and it triggers reactions everywhere, instantly.
We mentioned the what-to-watch indicators. I want to drill down on the Stellantis management call. You mentioned watching for the timeline for stabilization. What does a good answer on that call look like versus a bad one?
A bad answer is vague. It's corporate speak. We remain committed to our long-term goals and expect improvements in the coming quarters. That's fluff.
And investors hate fluff.
They despise it. A good answer is specific and painful. It's brutally honest. We are cutting production of these models by X%. We're reducing our capital expenditure budget by Y billion. We are exiting these 3 unprofitable vehicle lines entirely. We expect cash flow to turn positive in Q4 of 2026.
So you want them to take their medicine publicly?
Yes, the market rewards capitulation. It rewards management teams that face reality, however ugly it is. If they try to sugarcoat a $26.5 billion write-down, the stock will just keep falling. If they say, this is a disaster, we messed up, and here's exactly how we are fixing it, the stock might finally find a bottom.
And regarding the competitor updates and inventory levels, why is the days supply number the magic number to watch?
Days supply tells you how long it would take to sell all the cars currently on dealer lots at the current sales rate. A healthy number is usually around 60 days.
And what are we seeing for some EVs right now?
For some models, from some brands, we are seeing 100, 120, even 150 days supply. That is alarming.
That means cars are just sitting on the lot for 4 or 5 months?
Correct. And while they sit there, the tires get flat spots, the battery degrades slightly, and the paint fades. But the real problem is financial. The dealer is paying interest on that car every single day it sits there. This is called floor plan financing.
A loan to keep cars on the lot.
Exactly. And if interest rates are high and the car isn't selling, the dealer is bleeding cash on that car. So what does the dealer do?
They stop ordering new ones from the factory.
Which forces the factory to cut shifts, which eventually leads to the huge write-downs we saw with Stellantis. It's a chain reaction that starts on the dealer lot. So watching that day's supply number for Ford and GM's EVs is the best leading indicator of whether they will have to follow Stellantis down this path.
Wow. This has been a really comprehensive breakdown. We started with a headline about a dividend cut and a write-down, and we've mapped it all the way to the guy fixing his radiator in his driveway and the lithium miner in Chile wondering where his orders went.
It just highlights why you cannot just trade the headline. You have to trade the second and third order effects. That's where the real opportunities and risks are.
The market is a complex machine, but when you break it down like this, the gears really do become visible.
That is the goal.
We will definitely keep monitoring the STLA situation and the rest of the auto sector as these earnings reports continue to roll in.
It is going to be a very, very volatile few quarters for this whole space.
Before we sign off, just a reminder for everyone listening.
The standard but very important disclaimer.
This content is not financial advice.
And these are not buy or sell recommendations.
This content represents purely the opinion of the author.
Please always do your own research.
Thanks for joining us on Breaking News to Trading Moves. We will catch you on the next one.
Take care.